The charts I want to share with you today. Big Charting the Markets live webcast here. Great to have everybody. My name is Jerry Robinson, a contributor here at silverchartist.com, the founder of followthemoney.com. I'm an economist, author of the book Bankruptcy of Our Nation, and the founder over at followthemoney.com. I think I might have mentioned that already. And been following the markets for many, many years. I started trading in the late 1990s, mid to late 1990s. I started trading and then have been an investor as well. And love to just educate and share. We've been helping people all over the world for the last 16 years. We launched followthemoney.com in 2010, and that's where we met Steve Penny. Steve Penny became a member of Follow the Money back in 2015, 2016, and we hit it off immediately. And I've been very glad to see him start his own service here. He's done a great job, and I'm grateful to be helping out around here. Wonderful. So if you have questions along the way, feel free to type those in. We will be happy to address your questions, time permitting. But for now, let's go ahead and jump into our presentation today. We are talking about charting the markets. We're going to be focusing in on some of the broad financial markets, the dollar, the S&P, SCHD, which is this dividend growth ETF that Steve and I both like and that we invest in. But also we'll look at some our top-ranked silver miners right now, top-ranked gold miners, top-ranked uranium or nuclear stocks. So we'll take a look at all of that today. Now, let me always remind you at the beginning or the outset of these webcasts that you are trading and investing at your own risk. Neither myself nor Steve Penny are investment advisors. We share our resources and tools with you for educational and informational purposes only. We encourage you to talk to a trusted financial advisor before you make any investment decisions. So our agenda today, charting the markets. We got lots of charts, lots to talk about. And then along the way, feel free to type those questions in if you have questions, and we'll do our best to get them within the hour here. All right, let's just jump right in. I want to begin by taking a look at just where the broad markets have been over the last year, just over the year to date in 2026. Here we have oil back on top. Now, oil has lost a little bit of ground since we got some sort of calm down in the war that's going on. And right now, the direct U.S.-Iran exchange has been paused, but there really is no final settlement. Oil prices have dramatically fallen from where they were. Brent was about $100. West Texas was back at 90. I think this morning I'm looking at it, or I should say this afternoon. As I'm looking at it here, I see that oil has fallen. West Texas back up below 80, and crude has fallen from that $100 level back to about 85. So we've seen that, but tanker traffic is not normalized. So that's an important thing. Plus the war has migrated over to the Red Sea, where Saudi Arabia has a lot of its infrastructure. The Houthis in Yemen, that whole thing is becoming another problem. And then, of course, the Pentagon is running out of missiles to drop on Iran. They need to buy more. The cost of the war has been outrageous, of course, and nobody wants to talk about that. But tomorrow, the Federal Reserve is going to be meeting, and so they got a lot on their plate. We're going to look at the Fed funds rate here in just a minute and look at the futures market, see what it's saying. But oil, still leading the whole year. We're using DBO to track it. This is an ETF. That we use to track U.S. oil prices. And, it's down from where it was, but it's still, energy's still the big winner this year so far. Russell 2000 also has been a real champ. Small caps have just been defying the broader market, even with the NASDAQ having a good year, the S&P, doing good overall. You can see here, not bad. That's a 9%, in so far this year. I mean, most people will be happy with that for the whole year. That's what we've gotten for the first, 7 or 8 months. And so that's pretty good. The NASDAQ up, about 11.5. But look at the Russell. This is small caps. These are small cap companies. And typically what's so interesting about that is that small caps tend to be a lot more sensitive to expectations of higher rates. And that's really what's been going on. Is that, the market has somewhat been anticipating higher rates in the future. But overall, when you look at the data, it's difficult to imagine that it would support that rate hike. And so what's interesting is to see Russell 2000, to see small caps leading. That's unusual because they're much more sensitive to potential rate hikes and interest rates in general. So I find that to be somewhat interesting. Of course, small caps have really been beaten down for some time. So that also partially explains what's going on. The dollar also, just clinging to its gains this year. It's continuing to show relative strength, which has put pressure on gold, right? Gold is down about 7%, silver down 18% year to date. This is all as of last Friday. So this is like a little snapshot as of last Friday. Bitcoin and ETH down here toward the bottom. China also down as their economy has been hit by this war. Although strategically it's been a win for them economically, it's caused them to lose access in some ways to some of their cheaper oil supplies, and it's just complicated things. Fortunately, China's been cutting back its oil demand pretty big this year, in fact, as its economy's been slowing a bit. Now, also, over the weekend, over at Follow the Money, I put out 2 new ETF position uptrend alerts, and I just wanted to tell you guys here at Silver Chartist, just so you knew. One of them, in particular, probably in your wheelhouse. This is, agriculture. This is the Invesco Agriculture ETF, just forming a brand new position uptrend within our system, our profit tracker trend trading system that we have here at Follow the Money, and also the utility sector. There's 11 sectors in the S&P 500, the utility sector, XLU, forming a new position uptrend. So we're watching that. Now, it's a big week in terms of earnings this week, right? We've got a lot of things on the plate. Tomorrow, in fact, we have Agnico going to be reporting. We'll take a look at a chart of that pretty soon. But even tomorrow after the close, you have things like Microsoft and Meta. They're going to be reporting. And then you have Apple and Amazon on Thursday, right? Then you have ExxonMobil and Cameco, and you have Chevron on Friday. So there's a lot going on here. It's a big, big week for, there's Agnico Eagle Mines, right? AEM, that's our number 1 ranked smart score gold miner. Now, it's come down quite a bit. We'll look at a chart of it in a minute. But AEM is looking pretty attractive, especially from a longer term, kind of more of a position trading view. It's also, as I mentioned, FOMC week. It's Federal Reserve week. They're meeting today. They're meeting tomorrow. And tomorrow afternoon, they're going to announce their policy. Let's go check in and look at the futures market and see what it is telling us right now. Let's refresh and see if there's been any change. And there really hasn't. So this is the target rate probabilities for tomorrow at the FOMC meeting. Right now, 70.6% chance of no action, right? No rate hike, no rate cut, nothing. So right now it's leaning heavily in the odds of no change. This is what we think is going to happen. In fact, we don't think we're going to see any hikes this year. We expect to see a cut or two, especially as we get closer to the midterms. That's how things work, don't you? If you've been around the block a little bit, you know that the politicians love to cut rates right before the election. And that's what I would imagine they're going to do this time. And if they don't, I'd be wildly surprised. Doesn't mean they won't. Past is not prologue. However, that's my expectation. I still expect to see a rate cut or two this year. Looking at the expectation of a rate hike tomorrow, 29.4%. So there is a little small, relatively small chance that we could see a rate hike tomorrow, and it would be a 25 basis point rate hike. That's what's being expected. If we go out to say September, so we go out to the next meeting because there's no meeting in August, then the probability is actually for no change and or a cut. So right there, you have basically 80% chance of either no change or a rate cut, a 25 basis point rate cut. Well, actually, I should actually back that up. Scratch what I just said because I was reading those numbers wrong. Actually, in the month of September, we actually see the probability of a rate hike because right now the current target rate is 3.50 to 3.75, 3.5 to 3.75. Well, that's this number over here. So the next meeting in September, there is an expectation of no change at around 25%. That means there's close to a 75% chance of some sort of rate hike. Now, if that doesn't materialize, then everything has to be repriced. Risk has to be repriced. And if that's the case, then you could see the market take off because right now it appears to be pricing this kind of action in. Let's go out to October. Let's remember now, this is the one that is our current target rate. I got thrown off on that last image and I was looking in the middle. This is where the current rates are now. So when you look at October, once again, it's an even higher expectation of a rate hike. We're talking 83% chance of a rate hike in October, right? The month before the election. Again, the odds are high, but again, I am really not expecting that. And actually that's bullish because if it turns out that we don't have a hike, as I mentioned, you have to reprice the risk and that expectation could drive stocks higher. It could also drive the dollar lower. That's part of what's propping up the dollar is the expectation that we will have a rate hike. And again, when we get to December, there's only an 11% chance that we are still at this current rate level. There's an 89% chance that we have see higher rates than where we are in December. So as you can see, markets kind of expecting a rate hike in September, October, December timeframe. Okay, so toward the end of the year, right around the election. That would be interesting for sure if that happens. I'm not of the opinion that it will, but we shall see. The futures market isn't always right, of course, right? And neither am I, so we'll see what happens. Okay, so anyway, taking a look at all of that, now we kind of see what's going on. Gold down to about 4,030 or so. Silver sitting at about 57 and change. Platinum down at about 1,600. The dollar is still not able to get above 102. We'll see a chart of that in a minute. And the VIX backing off a little bit from where it had been. Okay, remember those two uptrend alerts I just told you about? Here's charts on those. Here's DBA. This one just forming a new position uptrend within our system. Position traders tend to like these alerts when we put them out. But as you can see here, DBA starting to look good. This one's composed of corn and wheat and soybeans and all of this. And many of these are on the move. Food prices are up big. And they just continue to show renewed pressure, especially with the ongoing war in the Middle East. Also, the S&P Utilities ETF. There's 11 sectors in the S&P, as I mentioned, 500. Utilities is one of them. And this one now, forming a new position uptrend within our system, XLU. Really a lot of sideways action here. But it's understandable. XLU, one of those more safer, it's kind of safe haven sector in many people's minds. Okay, so this next chart is the M2 money supply. And this, not going to belabor this too much, but I want you to see a couple of things here. The M2 money supply is like the aggregate money supply of various different things. I don't want to get geeky economics on you. Don't want your eyes getting glazed over or anything. But the M2 money supply is an important number, especially if you're a gold investor or your hard asset investor, because this is the monetary base. And anyway, as you can see here, things went haywire back in 2019 and 2020, right? They just went off the charts where you began to pretty much move straight up, right? We had this kind of slope going on here for quite some time. That slope there gives way to this slope. And then, of course, we had the hangover from that. Looking at this chart, it really is astonishing to see that the money supply actually went down for a period of a couple of years. Now, how do you make the money supply go down? Does the Fed go out and they just try to find dollars and just stuff them in their pockets and take it back to the bank and hide? How do they get money out of the system? Well, the simplest way to get money out of the system is to do what? Simplest way to do, anybody know? Let me go to my Q&A box or chat. What's the quickest way to lower the money supply right now without calling in any money, without going out and taking dollars and taking them back to the, to the Treasury? How would you cut rates? Does anybody know? I mean, I just told you actually. I just said it, didn't I? By cutting rates. Or actually by raising rates. Because when you raise rates, what happens? When you raise rates, it causes people to take their money and go stick it into the banking system, right? So it kind of gets it out of general circulation and gets it into the banks. And so we saw rates go up through 2022. Then you saw the money supply go down in that environment. You're looking at this chart going back since 1985. You don't really see a moment like this. We lived through that. That was pretty crazy. But now we're right back to our old antics. Look at us now. So now we have this really strong slope up, and now we're at $23 trillion in M2 money supply. Back when I was writing my book, Bankruptcy of Our Nation, and I was going around the country trying to warn people about a national debt, this was back in 2007, 2008, when I was really kicking all that off, 2006. The M2 money supply was I remember talking, it was 6, 7, 8 trillion. Now it's, 23 trillion. So it's just mind-blowing to think about how much the money supply has grown over the last 2 decades or so. It's wild. And this, of course, is why it's things like this that build the case for having hard assets, because they don't respect your currency. They don't respect your purchasing power at all. They don't. They're just going to keep printing and keep printing and keep printing, and they're going to try to lower rates as much as they can. This is what politicians want to do. Take a look at this chart, the 10-year yield, a very important chart that shows what happened. You and I, if you are 30, 40, 50 years old or older, then you've been living through a time period in your life where you were in a downtrend in the 10-year yield, right? The 10-year yield had been coming down since the early 80s. And as you can see here, we were hitting lower highs. That's the definition of a downtrend, right? So you have a lower high, a lower high, a lower high, lower high, lower high. You see it? There it is. Just keeps going, right? And so that you have that. And then you have lower lows, lower low, lower low, lower low, lower low, on and on. You see it, right? There's the downtrend, right? Lower highs and lower lows form a downtrend. Well, that suddenly began to stop. And we began to make our first higher low and a first higher high as we were heading into 2019. Then COVID happened, and we had to send, the 10-year yield went down because we cut rates to zero practically. And then we came up with a vengeance and then hit a new high. So now suddenly we're in a totally different environment and everybody feels it. It feels strange. It's actually not that odd. Rates right now aren't that elevated. I mean, they might feel that way because we've been living in this downtrending rate environment for so long. But this is really the key shift. Right, so now we have lower high, higher high, a higher high, higher high, right? And we're starting to make these higher highs, and then we have higher low, higher low, higher low, right? So we're starting to see this general uptrend here in the 10-year yield, and many people aren't comfortable with that, right? The economy has handled it well in some ways, it hasn't in other ways, but this is what we're living through right now. And much of that, of course, came in the wake of the pandemic. Now, if you look at the effective federal funds rate, as we were just talking about a while ago, sitting about 3.5 to 3.7, well, when we were back in 2007, 2008 timeframe, right before the crash, they had ratcheted rates up to about 5%, 5.5%, somewhere. It was like 5.25. And then you notice after that, they dropped it down to zero, left it there forever, right? And then you'll see that they began to raise them again in 2019, and then topped out about 2.5, about half that rate, and then they had to drop it again for COVID, right? So they left it down there for COVID for a good while, and then threw tons of money into the economy. Then we had this raising of interest rates, one of the fastest raising of interest rates we had lived through in our lifetimes, and they took it right back to where? Right back where it was back in 2007. It's almost like they just said, hey, let's go back to where we were. So they did, and now they've been trying to stair step it down, right? And the question is, are they going to keep stair stepping it down, or are they going to raise it back up again, right? This is a big, big question. The more this number comes down, the easier money is going to be. The higher gold goes, the higher Bitcoin goes. And the higher this number goes, it's going to put pressure on those risk assets, right? That's just how rates work. Anyway, so you can kind of see it visually here where we've been, these couple of episodes of dramatically low interest rates, followed by, raising of rates and then trying to bring them back down. Many people think we'll never get back to a zero interest rate. I think it's literally just a matter of time. And the reason is because A, I've seen them do it over and over, and that seems to be their policy. And number two, what are you going to do if we have another pandemic? What are you going to do if we have another massive downturn? Of course, they're going to just pull out the only thing that they have. They're going to lower rates. And so, yeah, I think we'll see 0% interest rates again in our lifetime because I think our government has no creative solutions, right? They don't have any plan to solve Social Security. They don't have any plan to solve the national debt. They don't know what they're doing, and they don't really care about your purchasing power. So, I can see them doing whatever they need to do to stay in power, and that's just sad. And again, that's why we own hard assets. That's why we think in these terms. Hey, by the way, if you happen to be out in California, specifically the San Francisco area, that Bay Area out there. I'm going to be speaking out there next month. In fact, it's almost exactly a month now. I'll be out at the Fairmont Hotel. Sits right at the top of that nice, beautiful hill where you can overlook San Francisco. If you're in that area, I invite you to come out. You can get details on that money show. I'll be talking about following the future. I have 5 different trends that you can't afford to ignore. We're going to get into AI, robotics, digital assets, demographic shifts, and changing and shifting energy demand. So we're going to talk about all that. You can get details and reserve your seat. followthemoney.com/money show. If you happen to be in that area and you want to come out and check it out, love to meet you. Let's take a look at the S&P 500 here, recently breaking out above its 200-day moving average back in late March after that dip down. And we had a nice rally, but now we're starting to weigh down on that 50-day moving average, even breaking down below it a little bit. We're still above a rising 200-day moving average. Right now, as it stands, I don't feel like we're in a place where we're going to see a big correction, at least not yet. And this is the primary reason why. Is this one of my favorite indicators, breadth indicators that I've been following for years and years and years. And I use it to help me know when to take profits, when to get more bearish, when to get more bullish. Basically, what this chart shows you is that 72% of stocks in the S&P 500 are trading above their 200-day moving average. And that number is bullish. You see here, we have it color-coded here on the chart. Once that number gets above 75, it's like a trigger for me, and I start to pay a little more attention. I start to begin looking for areas where there's froth in my own portfolio. Where can I, because I already do that anyway, but I pay more attention when we're above 75. When we get above 80, that's where I'm definitely trying to figure out where do I prune my portfolio. I need to take some gains here. It's the exact opposite. If we ever have the chance, and I think we probably will again because our market is so zany and roller coaster-like, that we will have opportunities to buy again down here. Here was your opportunity. Whenever less than 5% of the stocks in the S&P 500 were trading above their 200-day moving average. Wow. Imagine being able to buy that day, right? Or what about back in March of 2020, whenever the number of stocks in the S&P 500, only like about 90% of them were trading below their 200-day moving average. Pretty good opportunity, right? As far as like a mean reversion trade. Even back in 2022, we got down to like 12% of stocks in the S&P above their 200-day moving average. Well, we're far away from that. We're 72 now, right? But when we get down here in the bearish zone, this is where I tend to get more aggressive on adding to my high-quality positions in my long-term portfolio. When we get up here above 75, 80, 85, if we happen to get up in the 90s like we did back in 2021, then I'm definitely trying to sell and raise cash, right? Because I want to have cash for when we obviously correct back down. And what happens is that the reason why that happens is that the market normally grows kind of lumpy. So like if you look at the market at the beginning of this year, it was mainly driven by the energy sector and the technology sector. Okay, that was pretty much what was driving things. But we've seen it broaden out. If you may have been paying attention, but healthcare, for example, has been really picking up. It's looking really attractive. Many traders are starting to focus on healthcare stocks because they're really beginning to show strength. Financials are also starting to do good. So you're starting to see a broadening out of the market. And as you do, that number, that percentage of stocks begins to rise in terms of this indicator. And eventually, the market just broadens out to where nearly everything is included. And when that happens, you usually reach the end of the road, right? It doesn't mean that you end up with some massive crash, although that sometimes happens, but you just tend to kind of burn it out, and then it may kind of grind sideways for a while, and it may do this or that. But it's usually a pretty good time to take profits. We're not quite there yet. But when we are, I'm going to be more aggressive on taking gains, so I'll keep you posted on that. All right, let's keep going here. The NASDAQ 100 QQQM, that's the one that I own for the long term. I like QQQM. It's a cheaper version of QQQ, the NASDAQ 100, a nice way to invest in innovation, a basket of 100 stocks. We're coming down here after a nice breakout above the 200-day moving average. Could pull back to 200-day support. I would add more QQQM on a 200 touch. And if it goes below it, I would add even more. So I am looking to add more QQQM. Here is SCHD. Has anybody been watching this lately? I know that Steve owns some SCHD. He and I talked about that many times. This is one that I've owned for a long time. It's just a dividend growth ETF, right? It's a nice kind of portfolio stabilizer for me. It's not one that's really always going to beat the S&P 500, but it is going to pay growing dividends, and I like that about this ETF, and it's very well run. Well, we're getting a nice rally today while many things are pulling back today. Look at SCHD up 2.4%. Just a reminder that these high-quality ETFs, these high-quality stocks, They often serve, as I mentioned, as a portfolio stabilizer whenever you're having a bit more, friction in other areas of the market. I mean, even going back to say 2022, just sometime go take a look at what would have happened had you held SCHD versus say SPY. And if you look at that year 2022, where so many things were down, SCHD again played a stabilizing role. It just didn't come down as much as many of the other stocks and ETFs did, even though the market was down pretty hard. So SCHD, I like. It's looking really good here on this daily chart. Nice 50-day bounce last month that has now taken us to a nice level here. You can see here's a weekly chart where we're riding that 14 weekly moving average just like a champ. Looks really pretty. In fact, we bounced off that 50 weekly and then caught the 14 and haven't slipped below it since. So SCHD looking really great. Notice that it tapped its 200 weekly moving average earlier last year, and that touch was quite frankly, one of the very best opportunities to add a high-quality asset. If you can add a high-quality asset at its 200 weekly moving average, that's usually a really golden opportunity to add. Again, if you have, I'm not talking to short-term traders. I'm not talking to day trader. I'm not talking to somebody who wants to flip it tomorrow. Right? I'm not talking to house flippers, stock flippers. I'm talking to people who say, I want to buy a high-quality asset, I want to buy it right, and I want to sit tight and enjoy the gains, right? That's what I'm talking about with that 200 weekly moving average. So it doesn't go there, then automatically go to the moon, but that can be a great place to begin adding or adding more to your favorite holdings, assuming they're high quality. By the way, I just did a podcast episode on the power of dividend growth. I know Steve has been getting into that topic quite a bit lately. And then he's also been doing quite a bit of options as well here at Silver Chartist. Dividend growth is just a really great place to look whenever you are building out your investment portfolio. And there's 3 different areas that we track here at Follow the Money: dividend achievers, dividend aristocrats, and dividend kings. Dividend achievers are stocks that have raised their dividend every year for at least 10 years. 10 consecutive years, not just 10 random years. It has to be 10 consecutive years. And if they do that for 10 years in a row, they become dividend achievers. Companies like Apple, companies like Visa would be dividend achievers. They're on their way to becoming dividend aristocrats, which means that you have to be an S&P 500 company that has 25 plus consecutive years of dividend increases. That means every single year you're raising your dividend. Now, why would that be good? Well, A, that's money for the investor, which is good. That's how you make money in the markets, dividends and capital gains. But also, it shows the company actually thinks about you. It's actually thinking about its shareholders. It's trying to add more value to its shareholders. And so when a company does this, it's signaling to you like, hey, we care about the shareholder. We're trying to add value to you. We're not just like blowing the money and telling you to forget about it. We're trying to grow the dividend for you, right? And so dividend aristocrats can be a great place to look. We track all of the aristocrats here, Follow the Money. We rank them. We put out a leaderboard with all that. We have a lot of income investors. And then we have dividend kings as well. Now, dividend kings, these are companies with 50 plus years of consecutive years of dividend increases, right? That's wild to think about that. We're talking about companies like, Procter & Gamble, which has been around since like 1837, before the Civil War. We have these companies that have been around for a long time. They just keep paying dividends and keep raising them, So these 3 are, that's like the dividend growth hierarchy. You'll probably hear Steve talk about dividend aristocrats sometimes or whatever. That's what he's talking about. And if you like that topic, you should check out our latest podcast episode I did on that. You can on Spotify or wherever you like to listen to podcasts. Follow the Money with Jerry Robinson. The dollar is back at a 52-week high again. It's actually trying to break out. You can see here on those rising inflation expectations, and also with expectations of a rate hike at some point this year. So the dollar gets a boost by that. And you'll see that it's up here. It's fighting. This rally up to this area has also coincided with what? With the fall in gold. Where was gold's peak? Right there. Where was the dollar's low? Right there. Right? That makes sense, doesn't it? So the gold peaked right there. Silver peaked right there. And the dollar bottomed there. Right? Then the dollar began to go up since January. And which direction has gold went since January? Down. Which direction has silver been since January? Down. But what's been happening to the dollar? It's been going up. Right? So these are kind of yin-yang kind of markets, and it's important to understand. 102 resistance is what we're watching on the US dollar index. It's about 101.50 on this print here. 101.25 literally as I speak right now as I'm looking at the futures. But yeah, we're watching 102. It'll largely be determined, I would imagine, by the Fed tomorrow, because if the Fed comes out, and they're probably not going to tip their hand too much because they've already kind of given us a signal that they're going to be mum, unlike the past more transparent Feds that we've had. And so tomorrow the language will be obviously scrutinized from what is said by the Fed chair. But any kind of expectation or a firm expectation, like, yeah, rate cuts are probably going to be back on the table this year, that could drop the dollar quickly. If the Fed chair gets cornered into saying that, yeah, he thinks the hike is probably going to happen, you can see that dollar jump. And so it could go above 102. So it could happen this week. We've been watching it around that 102 area. I would watch that because that would be a significant breakout for the dollar. It could still run into problems around 104 because that's another big area. But 102 is that line in the sand that we've been watching. So let's see what happens there. And it may happen as early as this week. We may hit it and then bounce back down. That's a good sign. Or we may blow right past it and go above. That could be a bit more problematic, at least in the near term, for hard asset prices, et cetera. Gold sitting down here around the 4,000 level. It's in that demand zone. It's just been consolidating, going sideways, not really doing anything. 50-day moving average serving as major resistance overhead. 4,400 is a big level to watch. 5,000, of course, seems like a far way away now, considering we're at 4,000. But as I mentioned, I have begun getting more bullish now on gold in Q3 as an investor. I like to hold gold for the long term. I like to hold it as portfolio insurance. I was saying earlier that SCHD kind of serves as a portfolio stabilizer for me in the stock world. Gold serves as more like portfolio insurance for me. And I like to hold physical gold. I don't like to hold it in somebody else's hand. I like to hold it in my hand. And so that's the way we do gold. And right now it's about 4,000. I like it at 4,000. I'd like it better at 3,000. But at 4,000, I like it just fine. The big chart we were talking about for quite some time, and for those of you who've been following me here at Silver Chartist for some time, I was constantly pointing you to this 100 SMA chart to say, hey, when you're looking for the breakdown, watch that 100 SMA because it had been literally the primary line of support for gold since it broke out above that level in late 2023. And from that time, every time it would hit the 100 SMA, it would bounce off of it. And so it was like, great. We said, well, the day that it doesn't is probably the breakdown, right? And sure enough, after that December, January peak, what happened? Well, we came down and sliced right through that 100, and that was a sign for sure that we were starting to break down. Now the 100 SMA, which had been going up for so long, is now fully turned over, and it's coming down. So just from a technical level, keep an eye on that 100 if you're a gold watcher, investor, trader. Just kind of watch that 100 SMA. It's coming down now. That could be an area where if you're waiting for some sort of bullish signal, that will certainly be one of the bullish signals that we'll want to see. This is a little bit of an older chart, but just super relevant right now. Realizing that 71% of advisors, as of 2023, this was from Bank of America, and this has not really changed that much. I got some new data, but it's not a very good chart. It's not very visually kind, but the data has hardly changed since 2023. That 71% of advisors have 0 to 1% exposure to gold, right? Isn't that reckless and stupid? I mean, it really is kind of reckless and stupid to be all in paper assets, these guys, you know? And this is why when you go find a financial advisor, you've really got to find somebody who gets it. It's very important because a lot of financial advisors don't understand. They don't understand what fiat money is. They don't even understand what fiat currency is. They don't know what fractional reserve banking is. They don't know why in the world you would want a shiny rock like gold in your portfolio. You know, they don't. It's just like, really? I mean, so it's kind of strange, but that's the truth. And so very few advisors have even some little tiny amount of exposure to gold. And then, of course, gold and gold miners as a percentage of total global assets in 2024, it was 1%. If you go back, through time, you'd see gold and gold miners was a much bigger part of the total global assets. It's just not. Now, that's been changing a little bit as of late, especially in late 25 into 26, because gold has been moving on chain faster than almost any other hard asset. In fact, I think it is the fastest growing hard asset on chain. When I say on chain, of course, I'm talking about on the blockchain. So as of last month, actually as of May, I should say, tokenized commodities now hold roughly $7 billion, almost entirely backed by gold. That, by the way, is up around 300% over the last year and a half. So there's been a big move towards putting gold on the blockchain. Two tokens that lead that category, for those of you who are interested in the gold blockchain space, is Paxos Gold, which you probably heard of if you follow it, and also Tether Gold. These are the big gold-backed, tokenized assets on chain. And so just a little interesting update there. Pretty much the tokenized commodity value by token has been all focused upon gold. That's pretty interesting. Now, this chart, I could spend a lot of time on. I'm going to be pretty brief, but this is a really important chart that showed us where things broke down back in earlier part of this year. One of my favorite long-term charts is the gold to S&P index ratio, right? It's kind of one that we don't think about a lot. Instead of asking, is gold rising in price, this chart basically says, or asks, is gold outperforming U.S. stocks, or are U.S. stocks outperforming gold, right? Well, we know right now that gold's been coming down and stocks have been going up, so we know that the ratio is probably not favorable. But there are some key levels that you can use from this chart that are very helpful to you from a historical viewpoint. So when that ratio rises, that means that gold is leading stocks. And whenever it's falling, it means stocks are leading. Now, this goes back for the last 40 years, and you can see all the different peaks and valleys and everything. Back in 1987, of course, it was a 2.15% peak. Back in 2011, it was up here around 1.68. And so even when we hit all-time highs on gold, earlier this year, and in December and January, look at the peak here. We only got up to this level here. It was like in the 0.7 resistance range. So we didn't even get above 1, right? And the bulls were looking for a breakout above this range, and it just didn't really transpire, which is why many people think that there's still a lot more left in the tank for gold, because historically this thing tends to do better when we really get a good bull market going in gold. So regardless, a helpful one. We topped out right there back earlier this year, and we pulled back, and we're sitting at about 0.5. If we get down to the 0.4 support zone, this is where it really gets interesting, because this is where gold becomes really attractive price-wise relative to stocks, certainly over the last 40 years. GDX stuck in this downward moving trend here. You can see this downtrend here. And you can always recognize those downtrends pretty easy with the lower highs, right? The lower highs as they come down, and then the lower lows, right? As we come down, right? So you start to see it. So we've clearly got a downtrend going on here. We've got the 200-day moving average now breached. We have the 200-day moving average beginning, not quite, but beginning to flatten out. And now we have immediate 50 SMA resistance right overhead. So we've certainly come back down from our highs. With GDX, I mean, we were up at, say, 115 on GDX, which was pretty impressive, especially considering that we started the year in 2025 below $35, right? So that was an epic run. We are now giving back a lot of those gains, trading at about $75 right now. Now, this is also an interesting chart. If you go back to 2007, and maybe 19, 20 years now, and you just compare the price of gold to the price of GDX, because that GDX has been around since that same time. GDX has been around for a long time. And GDX, during that time frame, had you just plunked money, had you gone back to this time in 2007, July, and you put money into GDX, okay, you would be up 125%. Okay, that's 19 years. Had you put that money into physical gold, you'd be up 511%. And that's even after the big sell-off we've seen in gold. So you can see that miners. Now the truth is if you go back for the last 2 or 3 years and look at this chart, you'll see that GDX did outperform gold. If your starting place was, say, 2024. Okay, but if you start back further, you'll start to see, and you see this long period of underperformance that can go on. This is why Steve and I both try to stress to you, be careful when you become a long-term investor in mining stocks. That's not my favorite place to invest for the long term. I think mining stocks, I've been saying since I've come here, it's not something I buy for the long term. I buy gold for the long term. I buy silver for the long term. I buy platinum for the long term. I buy miners as trade. So when I buy a miner, I'm not planning on getting married to that miner. I want a high-quality miner, but I don't want to be married to a gold miner because over time, they can just do nothing, right, for very long periods of time. Versus just like a dividend aristocrat that's at least going to go up. I'd rather own a dividend aristocrat and a bar of gold than hold just gold mining, right? Because I think over time, you're going to do much better in that situation. So keep that in mind. Mining, great for trading. You can really amplify your gains in the gold market using miners if you're trading. But if you're a long-term investor, you got a bucket full of miners and that's your long-term plan, you better sell when they're up. I mean, you better sell when they're up, because if you don't, you might be sitting on it for a long, long, long time before the next rally. And that's not really, in my opinion, the best way to invest. But this chart is a good reminder of that. Okay, let me share with you the top-ranked gold stocks that we have right now over at followthemoney.com. We have a smart score ranking system where we look at several different areas, all different kinds of areas of the stock market. But the ones that you guys are interested in, of course, is gold, silver, and uranium. So I'm going to share with you our top-ranked gold, silver, and uranium stocks on today's call as well. Agnico Eagle Mines is our number one smart score ranked gold stock. By the way, smart score is something we invented many years ago. It's a fundamental system that has nothing to do with technicals. It's all fundamental data. And so you can learn more about that on our website, followthemoney.com/smart score, that talks about smart score system. But the point is that if you want to know about the methodology, which we don't have time to get into right now, But right now, Agnico Eagle Mines remains on top, and then Newmont coming in number 2. Newmont reported earnings last week, I think. They were great earnings. They were making good cash, but the sentiment now is weak. Gold has come back down, and even though now Newmont is making really good money with gold prices where they are, it just didn't get a lot of love, right? Because we're in a kind of the sentiment is kind of soured on gold miners right now and silver miners right now. Won't be that way forever. You know how things work. It just kind of ebbs and flows. Newmont coming in number 2. The price target, by the way, on Agnico 220. The price target on Newmont around 130. Then you have Anglo Gold Ashanti, and then you have IAMGOLD and Franco-Nevada, which is another great, well-run gold mining company. And that one has a price target of 278. IAMGOLD looks like it has quite a bit of upside based upon its price target, although AEM is our favorite, along with Newmont. Here's a chart of AEM. You can see that peaked out back in February, and it started that that downtrend that we can see very clearly here. Number 1 rank. That 200-day moving average is flattening out now, just starting to turn down. GDXJ, another one, looks just the same, doesn't it? Peaking out in January, again in February, and then that was it. And then it starts coming back down. Lost the 200-day moving average in June, late May, early June. And now we have that 50-day overhead hanging over us. We were about 150 on GDXJ. We're down to about 95 or so. So, it's been quite a hefty move down. Silver is in a very interesting place. Here we see this demand zone that we've been following now for the last couple of months, and it's holding on. This is, by the way, where we broke out. This is a key level right here. This is where we tried to break out back in September, October, and we failed. And then we tried it again and failed. And then we tried it again and then it worked. And then we held support there and then rallied on. So we tried, failed, and then broke out. Well, now we came back to the same level and we're holding it. Here, we came down and held it here, and we're still trying to hold it here. So if you break down below this demand zone, then you're probably going to get back down to 50, maybe even 40s. You may have a 4 handle on silver before it's all said and done, unless this thing turns around in a hurry. It's grinding sideways, though, which is also somewhat positive, indicating that maybe it's trying to bottom here. But regardless, I would be watching that demand zone very closely to make sure that it continues to serve as the demand zone and doesn't end up becoming an overhead supply zone if we drop below it. Right now, the supply zone, it starts at about 61 and goes up to about 63, 50, 64. That's where we tend to get all the selling. It pops up into that area and sells. And right now, even in this month, we haven't been able to get back into that zone. And that 30 SMA is actually acting as resistance right now for us at around 60. So watch that 30 SMA if you're on silver, you're watching silver, you're a trader, investor, whatever you're doing. And that supply zone is going to be a tough spot. We got to bust out of that to really get this thing going again. The weekly chart also tells the story on that 50 weekly moving average. Very important area. The opportunity to buy silver back at its 200 weekly came in 2024, right, where it was right around that area. One of the very best opportunities to buy any high quality asset is at its 200 weekly. Well, that was it. That was the moment. And then it was finding support at the 50 along the way, and then it peaked out, and then here we are back below a rising 50, consolidating here at same level between 55 and 60. Let's take a look at the top-ranked silver stocks according to our Smart Score system. Hecla remains on top. That's not really a surprise. Hecla is going to be reporting, I believe, next week. That'll be interesting to see. Their price target is $23.50. They're trading at $15 as of last Friday. So that's quite an upside potential there. AG, the First Majestic Silver Corp, number 2, also has quite a bit of upside. Then you have a few more that are a little lesser known. You have Aya Gold and Silver. This one made the cut. Silver Corp Metals. This one made the cut. SVM. Many of you heard of that one. And then Discovery Silver Corp. This one also making the cut. Very few silver stocks actually make it through our Smart Score screening because it's very rigorous. We're looking for many things. A lot of times mining companies just don't have the fundamentals to pass the test. These do. Doesn't mean they're going to do well, but historically our Smart Score system has worked out pretty well. Actually very well. And the Hecla Mining and First Majestic would be the two I would be looking at most closely if I wanted to speculate in that area. Of course, I would want to wait for a signal, confirmation before just jumping in. Okay, so this chart here is year to date. How are many of the focus markets doing that you guys focus on here at Silver Chart as well? S&P 500 up around 8.7% as we were talking about as of right now. The dollar is also up by 3.1%. So what about the rest? Well, gold is down about 6.6% year to date, as you can see here. Uranium down about 11.5%, and then silver down about 18.8 or so. So everything began to go below the zero line back in early June. That's also when the dollar started picking up also. So keep that in mind. That's been kind of hampering gains in this area or hurting sentiment in the area. I made this graphic a few weeks ago when I did another podcast episode on the topic of AI's power problem. And this is something that many people still aren't really paying attention to. They're in the AI space. They're chasing the hyperscalers. They're looking for AI plays, but you got to power AI, right? And so if you caught that episode that I did, you probably know what I'm talking about. But regardless, here are the stocks that we profiled in that episode. If you're interested, go back and check it out. Constellation Energy and Vistra, these two for the nuclear power generator companies. When it comes to the uranium and nuclear fuel cycle, we got Cameco and Centrus, URNM and URA as the key areas to look at. Then advanced nuclear next generation, Oklo. Wow, I just think we just hit, were we down to I don't know if we hit 30s yet or not. That might be symbolic I'm thinking of. Hold on, let me go look real quick at Oklo. I think it's the lower 40s. Nope, it's 30s. Wow. Okay, well, check it out. So here is Oklo, 39.43. So I've been sitting waiting patiently to buy this stock. I wanted to add it to my long-term portfolio. It's kind of like a speculative satellite. I ended up adding another company that I was going to add Oklo. It was one of them I was looking at another company as well that was related to data centers. And I ended up going with another company, which I just told our members about over at Follow the Money, which I think has about a 10x, pretty high probability of 10xing over the next decade, which is kind of my goal. 5 to 10 years, I want a 5 to 10x. Ideally is what I'm looking for when it comes to growth stocks. And so I have one that I just added over there for Follow the Money. Our Follow the Money members know all about it. Oklo, though, is one that I'm interested in buying, and it's just down. It's down 5.5% today, down to $39, below 40. Starting to get real attractive to me now. Oklo for that small modular reactors and advanced nuclear technology. Then you have the natural gas space and LNG. In this space, some of the companies we look at are things like EQT, Coterra, Antero Resources, Range Resources, also the midstream and pipelines like Williams and Kinder Morgan, Energy Transfer, and Targa. And then, of course, Cheniere Energy, LNG. And then finally, the grid infrastructure and data center enablers. Eaton Corporation, Vertiv Holdings, which looks very interesting to me. Quanta Services, GE Vernova. That's our top. That's GE Vernova is our top industrial smart score stock. This thing has been a killer. It's been doing excellent for a few years. And then the key ETFs around this space would be Grid and Pave. These kind of give you exposure to that AI infrastructure build out, power grid stuff. And so anyway, I thought this would be helpful to you. Don't forget that AI requires power, and power is something that we just got to get more of in this country. And so there's certainly ways to invest in it. These are some of the key themes of how we would do it. Let me talk about our top ranked uranium and nuclear stocks too. We're getting real close here to the end. Let me just talk about this real quickly. This will be our last slide. Constellation Energy sitting on top. I like Constellation a lot. Next Era Energy used to be my favorite utility, but that was for years. But Constellation Energy really started making a big move a couple of years ago, and it caught my attention. And I like Constellation Energy, CEG, even more than I do Next Era, NNE. So that's been a change for me over the last few years. Is I like this company a lot. I don't own any of these companies that you see here, but out of all these stocks, I like that one a lot. That's more of a utility though versus Cameco. Cameco would be my favorite uranium stock. Constellation would be my favorite utility stock, basically. Vistra's on here, Iron, which is a hot one as well, but again, lots of risk, and Altius Minerals. You can see that all of these have pretty high price targets relative to where they are now, especially Iron looks like it has a double from where it is now. So there you go, top ranked nuclear and uranium stocks according to our Smart Score system. And now let me turn it over to you guys and see if we have any questions that I can address before we close out. I hope this has been helpful for you today. I was looking forward to hanging out with you guys today. Thanks for letting me do this. Thanks for being here. Okay, now, let's see. I'm pulling these up. By the way, we did get some questions on Bitcoin, and I don't have time to get into Bitcoin. That's not really what we talk about here at Silver Chartist, but I do have weekly charts. I've been investing in Bitcoin since 2012, so I've been in the space for 14 years, which is weird to say. But anyway, you want my latest charts, my latest commentary every week, just go to followthemoney. Actually, go to followthemoney.com/Steve and use his affiliate link. That way you support Silver Chartist, you support Steve, and also get all of our stuff as well. So feel free to come over and join us. Followthemoney.com/Steve for Bitcoin and Smart Score and daily trading ideas and all the things that we do over there. That's where Steve is. In fact, Steve's been a member of Follow the Money, as I mentioned, for, I guess 10 years now. All right. Well, it looks like we have covered pretty much everything here. Great to have everybody here today. It looks like we had a really good, quite a few people here. Great to have everybody here today. If you have any questions or that we didn't address here today, feel free to put them below today's video post. When we put it up, we'll put it up here in just a few minutes. God bless you, everybody. Have a safe and prosperous rest of your week. We'll look forward to seeing you again next time. Take care. God bless.